Hi, and welcome to the Stock Scores Market Minutes for April 24th, 2017. This week's topic, resistance rules. I'll then do my market analysis and finally look at the trade of the week on EFII. All right, so what is resistance? It is a ceiling price that occurs at downward trend lines or past highs. So if you have a market that's looking something like this, you'll have resistance at the past highs, but you'll also have resistance at the downward trend line. Stocks that rally into resistance usually get stuck at resistance. So if this chart was to rally up to here, it would get stuck there. On the other hand, if a stock stalls at resistance, goes sideways for a while, and then breaks through, those stocks have a high probability of trending higher. A breakout is better if accompanied by increased volume. Let's look at an example on the chart of gold. This is the ETF GLD. I could draw the downward trend line, something like this, and you can see that we got stuck at that downward trend line and fell back. Why? Because the market rallied into that resistance level. However, we then came back to the horizontal resistance and stalled, went sideways for a little while, and then broke out right there, and that points to a higher move. Now, just to keep this in context, there is still longer-term resistance on the weekly chart for gold. We'll talk about that in a moment, but for the most part, that is a positive signal for gold. All right, here is the 30-day, 60-minute chart for the S&P 500, and you can see that we're generally winding our way lower. We have falling tops. We do, however, also have some rising bottoms. So we're building a pennant pattern where the trend into the pennant is down, and that means it's more likely to move down out of the pennant. However, if we get a break to the upside through this downward trend line of resistance, then we should move back to the highs set a couple of months ago. So at this point, this is still a bearish chart, not significantly bearish, but it is a chart where the sellers are in control. Looking at the longer term chart, however, just to put that last chart in context, that last chart is basically this right here. In the big picture, we remain in a long-term upward trend, a long-term upward sloping channel. And we are almost back to the bottom of the channel, which is the point where price should bounce. So we still have a little more to go to the downside before we hit that bottom of the channel, but up in here we were overbought, just like we were overbought in here and maybe even there. But as we get down to the bottom of the channel, we become oversold and the buyers get motivated to act again. Here's the Russell 2000. It too is in an upward trend. It too is coming back to the upward trend line. However, it's been more or less sideways for the last number of months, which makes it a difficult market to trade if you like to trade the small cap stocks. There is no enthusiasm, no strong opinion in this market. Moving along to the TSX 60, we're essentially where we were a month ago. We haven't really gone anywhere. We're more or less sideways, up slightly perhaps. We've got a little bit of falling tops in here, but it's really just a sideways grind for the TSX. Now what's important is that volatility is diminishing. I can draw a line across the tops and a line across the bottoms, and you can see that the amount of price volatility is compressing, and that's usually what comes before the next leg of a move. We don't know if it will be an up move or a down move until we break out of the pattern, but for now it is a positive sign because this is like a coiled spring waiting to be released for the next leg of the trend. And what direction should that be? Well, looking at the longer term trend, we can see that the longer term trend is up. I didn't draw that very well. Let me try that again. So the longer term trend is up. We're in this upward sloping channel. We've come back to the bottom of the channel where we should bounce and move to the upper part of the channel. The risk is that we break down, breaking that upward trend line, in which case we're probably headed to the next level of support, which would be down in there. TSX Venture is also slowly compressing in its volatility, but this market has actually fared better than many because we've seen a little bit of resurgence in the commodity sectors. Oil and gold over the last 2 months have done fairly well. Now you'll see that in the last week we had some selling pressure there. That's because those commodity sectors actually fell back a little bit last week collectively. And so we're basically, we go up, we retrace a little bit, we go up, we retrace a little bit. The next move should be up, but again, what you want to watch for is a break of this downward trend line of resistance as a clue or a sign that the market is going to make that next leg up. Now, U.S. Treasuries, this represents the U.S. bond market. If this goes up, interest rates are going down. If this goes down, interest rates are going up. And you can see that we have a downward trend line there and we were oversold, and now we're coming back up to that downward trend line where I expect it will stall and roll over and retest the lows. If it can break the downward trend line, then it should move back to the highs. But the probable thing to happen is it will roll over and test those lows. So we have, let's say, a 65% chance of coming back down into here and a 35% chance of breaking that downward trend line. Breaks the downward trend line, that means interest rates going down. Breaks down to here, that means interest rates going up. US dollar has been slowly grinding its way lower. That's called a falling wedge pattern. It's a sign that the sellers are not really strong, that the buyers are more weak than the sellers are strong. And so typically what happens is you get an upside breakout from that pattern and the US dollar moves on higher. We haven't seen the break of the pattern yet, so we want to watch for that, but that's what probably will happen. And the gold chart. So this week I drew in advance a trend line because it's always hard for me to draw a perfectly straight trend line freehand with my little pen tool here. So what you can see though is that we were heavily oversold on gold. That was back at the end of 2016. We've rallied back very nicely to get back to the downward trend line. We closed just above it last week, only slightly, and now we're stalling there. So the question is, do we pull back into that pattern below the trend line, or are we just stalling here and then ultimately going to break higher? Given the short-term chart that we looked at earlier, I think we're more likely to stall here for maybe a week or two, maybe 3 days, who knows, not stall for long, and then move back towards these highs. That, I would say, is the 70% chance of thing happening. We have a 30% chance that we fall back into that downward trend line. And finally, the oil chart. Well, not finally, we got one more to go. Here is the downward trend line. We rose up to that with a nice bounce back in oil, and we fell lower when we hit that. Same thing that we talked about earlier. Markets that rally into resistance, rallied into resistance, got stuck, pulls back. We're really in this long-term sideways boring pattern where we just kind of gyrate around in that pattern. There's not a lot going on in oil. It's kind of a market best left to not trade because there's not a lot of volatility there. And finally, the VIX chart. We had a little jump up in fear last week. We saw that fear dissipate a little bit, but we still, if we were to break higher from here next week, we would have a break from a rising bottom. So I do think this is a chart to still keep an eye on. But as so often happens, we get little breaks higher and then they fizzle out. We'll see if that's going to be what happens now. All right, so my outlook then on US stocks: bullish long-term, bearish short-term, neutral on both time frames for the Canadian market. Gold, long-term neutral, we're right at that downward trend line. Bullish short-term, it does have good upward momentum. Oil, neutral long-term. We've been in that sideways pattern for a while, but we've rolled over at resistance, and so I put a bearish rating on it short-term. Investor opinion made a return to the market on Thursday. We saw a lot more action on Thursday and Friday, and though direction is still being debated, at least there's some enthusiasm there. With price volatility still directionless, traders should be relatively short-term focused. Investors, if you have that longer-term view, you're still in that longer-term upward trend, and so there's really no reason to change from that yet. Oil did get stuck at resistance, as we expect. Gold is now stalling at its downward trend line. Fear falling, but I don't think fear is necessarily out of the question yet. All right, moving on to the trade of the week. This is a short trade. On Friday, EFII gapped down big time, traded abnormal volume. That's what puts it on my radar screen. And we had my message candle indicator triggered right here, which told me that that stock was likely to move lower, and it did exactly that. Over the course of the following 2 hours, it dropped 4 or 5 RR, went down as much as 5 RR, you can see there, 5 RR, closing the day at about minus 4 RR or plus 4 RR, which means if you risked $1,000, you made $4,000 on the trade. That is a little short trade. I don't show those very often, but Friday actually had some good shorts, and so we're seeing more of that lately, and I think that tells us something. All right, well, that's been the Stock Scores Market Minutes for April 24th, 2017. Have a great week in the market. Subscribe to the channel, like it if you like it, and leave a comment below if you'd like me to look at what you are wondering. Have a great week in the market. Trade well.